Meanwhile, our countdown closer says investors need to diversify when it comes to big tech, stocks like Google. Joining me now with about $11 billion in assets under management is Matson Money founder and CEO, Mark Matson. Mark, thanks for being here. You say to diversify. Where should I go?
Yeah. Well, first of all, I want everybody to understand the mistake that most people make right now in this market. It's not unlike 1995 to 2000. Large company stocks made 22% for 5 years in a row. Tech stocks made 45%. So everybody's dumping all their money right now into large stocks and tech stocks. A big mistake. Large stocks lost 55% after that. Tech stocks lost 75%. You've got to diversify into small stocks, and you have to diversify internationally, and don't just bet all on large tech stocks in the United States.
When you say international, we're talking about China pulling out the bazooka and all of their stimulus. Does that look attractive?
Yeah, when I'm talking about international diversification, I'm not talking about China.
Okay.
I'm talking about Europe, emerging markets, Asia, but not China. They're really a communist regime, not a true free market.
Well said. And we hear you loud and clear. I was astounded when Charles Payne was telling me Abercrombie & Fitch is one of the best stocks that he has seen this year. But the retailers today under some pressure with sort of the risk off mode here that we're in. Should I be in the retailers?
Well, that goes back to the diversification story. We have over 2,000 small company stocks in our portfolios and 22,000 different holdings. Most people dramatically underestimate how much they need to truly be diversified. Most people feel like if they have 5 or 10 stocks, that's diversification. That simply won't do it. And Abercrombie is just one of the micro-cap smallest companies that are out there. And as you said, they've done very well this year so far.
What should I avoid right now?
Well, you were just talking about it. Several really toxic investments out there right now. I know everybody likes gold, bad decision.
Why?
Very high standard deviation or volatility, historically only a 5% rate of return. Any cryptocurrencies, the right price for crypto is zero. It's all based on the bigger fool theory. There's no assets. There's no intellectual property. There's no company. It's for speculating and gambling, not for real investors. And whatever you do, stay away from long bonds. If interest rates continue to go up and they get out of hand, already mortgages are 7% for 30-year fixed. You could be looking at those bonds crashing if interest rates go up another 1 or 2%.
Okay, but help
Stay away
me
from
out
long
here,
bonds.
though, because if I'm a safe haven investor, I think bonds and gold. Where do I go then if I'm a safe haven investor? Do I go to cash?
No, what you want is short-term, high-quality fixed income, both government and corporate. So you're looking at bonds in the 3 to 5% maturity for federal or government, and then you're looking at bonds credit anywhere from 5 to 10 years. But if you start extending those maturities, an interest rate's going to kill you if they go up.
Well said. Well, anytime you mention standard deviation on the show, in my book, you are allowed back. But I may be the exception to the rule on that one. Mark Matson, thanks so much. I really appreciate it.